It seems like a lot of us have gotten used to chasing the next big thing in the crypto space. These speculative trends that often end up being just a flash in the pan. And for years, the question has been, what is Ethereum's real killer app? What is that one thing that's really going to take Ethereum mainstream? What is that thing that will finally bring mainstream finance on chain? Is it supposed to be crazy high yield farming? Is it supposed to be political meme coins?
No, God!
Vitalik recently proposed a different answer. Vitalik argues the key isn't something speculative at all. In fact, he argues it's something kind of boring.
Boring!
He calls it low-risk DeFi. And today we're going to unpack exactly what that means and why this boring stuff might just be the most important foundation for crypto's future. Welcome to Unwrapped, a series in the BMX Crypto podcast where we explore DeFi, NFTs, on-chain culture, and all things in the BMX ecosystem. Our mission today is to unpack Vitalik's latest blueprint. What is low-risk DeFi exactly? And why is it so important for bringing DeFi into the mainstream? And importantly, how does the design of things like wBLT and the whole BMX structure put this theory into practice? Just before we jump in, the usual but quick reminder, this is all for educational purposes only, and definitely not financial advice. We're here to explore the ideas and figure out what it all means together. All right, let's get to the heart of it. When Vitalik talks about low-risk DeFi, what is he leaving out? Because for a lot of people, let's be honest here, DeFi still brings up the idea of unsustainable farming, super risky token launches. And that's exactly where Vitalik draws the line, right at the start. Vitalik defines low-risk DeFi by first saying what it isn't. It's not the crazy, unsustainable token emissions from the 2020 DeFi summer. It's not backed by what he calls temporary or recursive forces, the protocols that only work if people keep piling in, or if users are just looping leverage to chase incentive tokens. Those things might create a temporary boost, but they don't actually sustain the ecosystem in the long run. They're here today, they're gone tomorrow.
You're here today and gone tomorrow.
Flash in the pan. Instead, what Vitalik is describing is a more mature financial layer that focuses on two pretty simple things. First, providing ways to save and make payments using valuable assets.
What do you mean by that?
Think stablecoins and the majors like ETH and BTC. And second, making sure there's global permissionless access to those tools built on protocols that are robust, transparent, and truly battle-tested. And this leads him to a word we don't hear often as a compliment: boring. He flips it and says it's a good thing. So why is boring good? Boring is good because boring means durable, sustainable, and that's the key. Vitalik argues that we need less of the casino vibe and more of the reliable savings account model. And he makes the point that this low-risk model is only really feasible now because the core DeFi infrastructure has matured so much. And if you look at the data, the risk of actual loss as a percentage of total value locked has dropped pretty significantly from around 5.5% in 2019 to nearly zero today. Hacks still happen, obviously. But they're increasingly being pushed out to the further edges of the ecosystem, as Vitalik puts it. And that point leads into his bigger philosophical argument that this boring, low-risk DeFi is actually the foundational killer app that can be for Ethereum what search was for Google, right? And let's think about that for a second. Google does all this amazing stuff. AI research, open source projects, Go language, but most of those things are pretty negligible or even negative for revenue. So what actually pays for all that innovation? What pays for it is Google search and Google ads.
Here comes the money.
Here we go.
That's the foundation. And Vitalik argues that low-risk DeFi can play that same fundamental role for Ethereum. It's the steady, positive sum bedrock that keeps the economic engine running. It generates the consistent, high-value, high-volume transaction fees needed to secure and grow the network. And that stability then allows all the other stuff to exist, the riskier experiments and non-financial apps, without needing to immediately generate huge profit themselves. And that really connects the dots between the big vision of a decentralized internet and the practical need to pay for security and block space. But what's the actual value proposition for the user? If the yields aren't going to be 1,000% APR anymore, who is this really for? And this is where he talks about non-Ouroboros users. Value isn't some magic secret sauce for sustainability, creating much higher yields. The magic, as Vitalik puts it, is making the economic opportunities that already exist accessible globally and permissionlessly. So what does non-Ouroboros mean in real terms?
Bro, what are you talking about, man?
It's basically people and businesses who need access to mainstream assets, but don't have the reliable traditional finance channels to get them. Think of a small business owner in Argentina dealing with massive currency instability, or someone in a country with strict capital controls. These people don't need crazy high returns. What they need is a transparent, globally accessible vault that holds value without worrying about bank runs, hyperinflation, or having their assets frozen. And this leads to another powerful point that Vitalik makes. For a growing number of people around the world, the tail risk of traditional finance, government seizures, hyperinflation, a banking system failure, those risks might now be greater than the tail risks of using a mature, well-audited DeFi protocol. And that's a massive shift in perspective, right? We in crypto often fixate on smart contract risk, which is real. But Vitalik forces us to zoom out just for a moment and consider sovereign risk as well. When protocols are open source and transparent and run on decentralized infrastructure, they offer a fundamentally different kind of trust. For people living under institutional instability, this permissionless access stops being just an investment. It becomes an essential utility. Okay, so we've got the philosophy down, right? Boring is good. Boring is accessible. Boring is foundational. Now let's bridge boring with the practical. And how is the BMX ecosystem actually doing this, right? This is where the rubber meets the road. The alignment is pretty striking. The wBLT architecture seems designed with these sustainability principles baked in from the start, right? And you can see it in 4 key ways. First is access to valuable assets, right? That's something that's very clear in Vitalik's essay. wBLT isn't some new speculative token. It's a diversified vault backed by the top blue chip assets: USDC, CB, BTC, Coinbase's Bitcoin, and ETH. Second is that it's economically sustainable, right? This is central. There are 0 token emissions in the design. Unlike protocols that print their own tokens to incentivize liquidity, which often leads to inflation and dumping.
Dump it.
Whether that's leading to inflation and dumping within a few weeks, a few months, a few years. Nothing in the BMX system is designed for token emissions. It is designed for sustainability. wBLT accrues real value from a blend of actual on-chain activity, right? And we can think of it as a core liquidity hub that captures value from trading fees, perps, NFT sales, right? Minting and redeeming wBLT itself. It's basically financial plumbing that routes value that's already flowing. right? Plumbing is boring, but plumbing is necessary. Third, it's lower risk by design. And I say lower because it's not without risk. It's not low risk because there's risk in nearly everything in our space, right? It's everyone's responsibility to ensure they understand that risk and are willing to accept it. But wBLT is built like a urine-style vault, which means it automatically takes the fees it earns and compounds them back into the underlying assets, right? The BTC, the ETH, the USDC. And this multi-asset vault structure is a well-understood and battle-tested approach in DeFi, built for a long-term saver, not a hyperactive day trader. Diversification across different blue chips actually lowers the systemic risk of being all in on a single asset or a stablecoin. And that leads to the fourth point. It's composable and foundational. wBLT is designed from the ground up to be pristine collateral, usable in lending markets, and most significantly, it's the base pair for all liquidity pools on the upcoming Deli Swap decentralized exchange, which means if you're a liquidity provider on Deli Swap, your counterparty asset, the wBLT you're pairing with, is itself already earning fees from various activities, while also having exposure to those blue chip assets. It's a unique kind of stacked benefit that you don't see elsewhere. So let's pull back again to the bigger picture. Why is this something the wider Ethereum community can rally around? Well, because any activity on a decentralized ecosystem has to be viable as a cultural rallying point. It loops back to the Google analogy, right? Vitalik noted that Google's ad model incentivizes data hoarding, which clashes with an open internet ethos. Low-risk DeFi arguably creates better alignment. It contributes economically to Ethereum, uses ETH as collateral, pays gas fees, serves what Vitalik calls a clearly valuable and honorable purpose. It needs to be something that is, in his words, at least not actively unethical or not embarrassing. Its infrastructure, you can genuinely argue, is making the world better. Building this stable, quote-unquote boring foundation doesn't just solve current problems. It sets the stage for what comes next. Because once this low-risk layer is established, you can start thinking about the next generation of financial services. Things like reputation-based, under-collateralized lending, which could be a powerful engine for financial inclusion. More advanced hedging tools using mature prediction markets. Maybe even moving beyond USD-pegged stablecoins to assets like flat coins pegged to a consumer price index. But you must have that solid low-risk foundation first. So really, low-risk DeFi represents a fundamental shift, moving away from DeFi as just a high-stakes casino and towards building a central, transparent, globally accessible financial plumbing. And within the BMX ecosystem, wBLT and Deli Swap aim to be a practical working example of that blueprint, proving that these positive-sum systems can be economically sustainable without resorting to unsustainable emissions. All right, let's wrap up with a final thought here. Vitalik argued that the transparency and automated nature of a mature DeFi ecosystem could eventually make it more stable than TradFi. And if that transparency and stability really take hold, what parts of the legacy financial system, right, the everyday services like checking accounts, treasury management, might be the first to be seriously challenged or even replaced by this new wave of low-risk infrastructure being built right now, right? Lots to think about there. Thanks for listening. I hope you found this helpful. Low risk might be boring, but boring is sustainable, and boring lays the foundation for everything else. Thanks for listening, and we'll catch you on the next one.